Welcome. We're going to talk today about the hedge fund conspiracy, how they're triggering your stops to steal your shares. My name is Darren Fisher. I'm the CEO of Maverick Trading. So let's begin. So what is this conspiracy? Well, it goes as this. I trade stocks. You trade stocks. We use stops to limit your risk. As you should. You should always be limiting your risk when you're trading in anything. But my stops keep getting triggered, and I'm forced out of my position. This is very annoying. You invested a lot of time getting into your position. You've researched the stock that you want to get into. You have a reasonable profit target you want to go. That pesky stop kept getting triggered. But once that happens, the stock immediately rebounds. I mean, immediately. As soon as you're dropped out of your position, it goes up, finishes up higher for the day. And if we had been able to stay in that stock, if our stops had not been triggered, we would have been profitable. So, what's our initial conclusion here? Well, as any reasonable person would think, it has to be that hedge funds, market makers, and other nefarious actors, yes, I actually use the word nefarious in a sentence, they're out there to knock me, not specifically knock me out of my trade. So what's the solution? I'll trade without stops from here on out. Those SOBs will never knock me out of another trade again. Yes, that has to be the solution. Stop, please. Please, please, please do not do this. It's a really bad idea. If you're going to trade stocks themselves and you're going to manage the risk, you have to absolutely use stops if you are not going to be watching them 100% of the time. If you're watching them 100% of the time, you're probably not getting a whole lot else done. So we're going to go into some different things that we can do, but please do not trade without stops. All right, what should we do then? First, to understand the solution, you have to understand the problem. If you understand the problem, it no longer becomes a problem. You can work things around it. So what is the psychology of the solution here right now? Psychology of the situation here right now. Okay, we have to take a look at institutional order flow. A lot of people that are looking at this are trading on the retail level. Institutional orders come from people that have at least 100 million in assets under management. These people are trading huge portfolios. They could be mutual funds, they could be hedge funds, they could be retirement funds, they could be any type of fund out there. These are institutions. Now, the execution traders are the ones that are actually making the trades. A lot of the portfolio managers, a lot of the decision makers, they direct what trades to be made. And once they do that, it's up to the execution trader to go out and actually physically make the trade. Now, these execution traders are the same people as you and me. They have the same motivations as each of us do. They are greedy. That's their path to reward. But they also have fear. That comes from negative reinforcement. The same reasons why people trade the market, greed and fear. These people are often told to buy or sell based on the VWAP. Now, if you haven't dealt with it before, VWAP stands for volume weighted average price. And what that basically is, if you have to buy X number of shares of something and you put it in at 3 orders, one at $49, one at $48.50 and one at $48, your average price volume weighted is going to be about $48.50. So they try to get in below a certain volume weighted average price. Traders are going to buy as low as they can and sell as high as they can. I mean, that's a no-brainer for anyone who's been trading. But these people, these execution traders, also know that other people are intellectually lazy. You're intellectually lazy. I'm intellectually lazy. We're all intellectually lazy. So what that means is that stops get placed around identifiable marks. Now, depending on the stock, it could be in a 25-cent increment, a 50-cent increment, dollars. You'll get your higher price stocks, $5, $10. The stops all tend to congregate around here because that's what our brain goes to. Our brain likes, round numbers or easily dividable numbers. Quarter of a dollar, half of a dollar, a straight up dollar. They'll also tend to stick around moving averages. You move, a certain percentage below a certain moving average, whether it be the 20 or the 50 or whatever you're looking at to trade. More importantly, whatever other traders are looking at to trade, then those stops all tend to congregate there. And that's how these execution traders can begin to take advantage of those. So here's the mechanics. Now this works best on stocks with thinner volume and recognized volatility, and we'll see why in a little bit. Put yourself in the position of an execution trader. You're given an order to buy 100,000 shares of XYZ stock, but with a VWAP under $40 a share. So that means the average based on the average volume, your average price should be under $40 a share. Now the stock just made a move from 35 to 40, and it's now on a high base between 39 and 40. You know that it is likely that there are sell stops at about $39, or some people trying to be a little bit smarter, $38.99, around that area. So what do you want to do? Part of your bonus is how much profit your trades generate, really based on how well you execute the trade. You have two criteria. You have to get 100,000 shares, and your VWAP has to be below $40. You want to buy as low as you can, but a 100,000 share market order is going to move the price, and you'll probably blow past your VWAP target. When that happens, that's not good for you. It's not good for your portfolio manager. Your portfolio manager gets angry. He starts yelling at you, and it just becomes this cycle of you really don't enjoy going to work anymore. So what are you going to do? First thing, XYZ chart goes onto your watch list. And you watch the price, and it gets closer to 39. I mean, this is not something you want to do at 39.90. You need to wait for it to get pretty close to 39. And volume is light. Remember, the stock is in a base between $39 and $40. So there's really not a whole lot of people buying, not necessarily a whole lot of people selling. Volume is pretty light and steady. The first thing you do when you want to do this is you are actually going to short 20,000 shares of XYZ at the market. You're not going to short at a limit. You're not going to short at a time. You're not going to try to short a little bit at a time. You're going to short a whole 20,000 shares of XYZ at the market. This is probably going to knock the price down, down into that 38.90 range. Well, 10 cents below that 39 where you thought a lot of stops were going to hit. Now, this is a second order effect. Once you've triggered all those stops at 39 and these sell stops, that's going to push the price even lower. So it's not even that initial short of 20,000 shares that knocks you out. It's probably the secondary effect of everyone else's stop being around $39, getting triggered, and then pushing the price lower, and that's when you get knocked out. So XYZ goes down, keeps going down, then it starts to catch a bid, about 38.25. Now, you as the execution trader, your problem now is that you need to first cover your 20K short and then get long another 100K. You can't put in a market order for 20K shares without spiking the price. The same reason we wanted to spike the price by immediately shorting 20,000 shares. If we put that out at market, put a buy order at 120,000 shares at market, we're going to, again, spike the price. All the work that you went into would have been wasted, and you'd blow past your VWAP price again, and it would not be a good thing. So what we're probably going to do there is start buying in 5K increments. There's a couple of things you can do. You can iceberg the order, which means you have on some of your more advanced brokerage platforms, you might say you want to go buy 10,000 shares, but only show 1,000 at a time. And that way, when you're going in there, nobody really knows. It doesn't show up on level 2 what the actual size of the order is. It's just going to keep repopulating at 1,000 shares on the level 2 quote. So that's what you want to take a look at. You might want to iceberg the order. Now, some advanced brokers also have a VWAP order tool, and usually the execution traders are trading on more advanced platforms, so they actually might put in, hey, I want my VWAP price at $40. I need 100,000 shares, and let the computer work the order. Sometimes that works, sometimes that doesn't. But here's the thing: they've just taken out a bunch of orders, and they've just spiked the price lower. So the ask can get real thin at this point. They might not have a choice but to just continue to buy at the market, and they may even blow past their VWAP at the same time. So they've just caused you some problems, and they're causing themselves some more problems. Okay, so the first thing we're going to look at right here, you see this is an hourly chart of Avera. That's from January 24th, to February 20th. So we see here on the 20th of January, near the close, the price went below 40, but no real orders got triggered. There was nothing really right there. Now, looks like what someone did is they had a pretty large sell order at the market on the open on January 29th. At this point right here, you can see there's not a whole lot of volume in this at all, but when they put this order out there, it looks like it triggered a lot of the stops that were at 39.50. You look before here, there's nothing that's been triggered at 39.50, so that's probably where a lot of the stops were. For the next couple of hours, it went down. Then you can see down here, about third hour into trading, still on very light volume down here, we managed to catch a bid. At that point, his shorts got covered, and he began to, put into his position. Still, you look down here, not a whole lot of volume in this move at all. Then this is probably just normal, normal selling right here, and then the rest of his order got filled in the next few hours. This is probably a VWAP at about $40. I can't tell you the size. I mean, this is something that the average daily volume on this is less than, around 100,000 shares. It's certainly less than 200,000 shares. So this is a pretty thin market right here. We go over here to the 11th of February, and we can see here, it looks like there's some stops that got triggered at 43, and it was low volume selling, throughout the day down to 42. Now you look at this candle right here, you can tell that the bid was very thin. The ask was very thin up there because a small amount of volume here spiked the price up, and there was nothing else left to support it. But it looks like the next day the volume did go up. So this was probably a VWAP order at about 43 is what this looks like. Now this is Rapid 7. This is the hourly chart from February 27th to March 26th. And you can see here at the open, there was a spike above 45, but there was absolutely no follow through on here, so it was fairly weak. We know that there wasn't a whole lot on the bid right there. So this would be, if someone wanted to get in to get a long position, this might be a pretty good place to do it. So at this point, someone probably came in shorted, and then any recent stops that just got put in probably got taken out at about 44.75. If not 44.75, then 44.50 in the next hour. So both of these, you can tell right here, a similar thing happened. This is probably a VWAP order down at 45 here, another VWAP order at 49. For somebody who did this over a period of a couple of weeks to get into a longer-term trade. Now that's what a lot of people don't understand, is that institutions typically take between 8 and 12 weeks to get into a position or get out of a position. They can't be as nimble as retail traders can. They have to plan these things out when they're going to go. If they're going to buy, they need to buy on weakness, or they need to try to take out some stops to artificially momentarily force the price a little bit lower. So whereas a retail trader can be in and out in a day, maybe 2 or 3, the institutional traders have to take a much longer look. And the same is true when institutions are getting out of their orders. If it took them 8 to 12 weeks to get in a normal market, it'll take them 8 to 12 weeks to get out. When you see large price movements, that's a lot of institutions all doing the same thing, trying to get into orders or get out of orders at the same time. So that's one thing to bear in mind, is that as a retail trader, we are much nimbler. We just need to know what's going on, what the institutions are doing, and see how we can take advantage of that, or at least mitigate the effects. So there are some dangers actually for the execution traders. I mean, we think it's very annoying when we're in a stock and it gets stopped out because of this practice, but it doesn't always go well for the execution trader. Stop orders are held at the broker. They're not held at the exchange. So don't worry about putting a stop order in thinking that the market maker is going to see it. They do not show up on a level 2 or level 3 quote screen. Here's one thing where the execution traders can have issues. They could initially go short, but find that their entire order caught a bid. So let's go back to, we're trading XYZ. Initially, we wanted to get short at about 39 to try to force the price a little bit lower and hit some of the stops. What if I short everything at 39 and there's not a blip? Someone else came in at the same time wanting to buy 20,000 shares, or there were bids that didn't show up that ate the entire amount that I wanted to sell, and the price starts going up. Now I'm in a position that initial short caught a bid. Now I have to clear not only the 20,000 I'm short, but then get the additional 100,000 shares that I was supposed to get to begin with. I have to do it at a higher price. So that's not good. So the conundrum for the retail traders. This is a known issue. This is not something that's new under the sun. This has been going on really, there is no conspiracy where institutional players are specifically targeting you. Bob Smith. They are not targeting your stop loss orders right away just to get your shares. It is simply other larger traders acting in their own interests the very same way you are. And sometimes the move is actually genuine selling, in which case you want to have your stops active to make sure that you're protecting your capital. So, what can you do? If you get knocked out, if this happens to you and you get knocked out, the simplest thing to do is put a buy stop in where you got knocked out. And what this is going to do, you're going to end up paying commissions. That's just cost doing business. But if it is a false move and you do see that it was an institutional trader attempted to spike the price lower and then buy up, you just put that buy stop in there. If it comes back, your buy stop will get triggered again. That's probably the simplest way to do it. You just have to watch it, be able to put it in there, a couple minutes after you get knocked out. After you see it clearly moves down, you can get in at the same price you got at. I would not chase it down. I would not recommend you doing that because you really don't know if it's genuine selling or not. The other thing you can do is, especially you're coming up an event within a couple of weeks, start with a smaller position size, but use a wider stop. And people are say, well, I know what I want. I know the position size I want to get into. Well, if you want to, buy 100 shares and have a $1 stop and only risk $100, you could still start with a 50 share position, but have a $2 stop. You're still risking the same $100, but you're probably not going to get stopped out as much. It's going to give you more time to sit through some volatility. Now, when you do this, it also gives you the opportunity to pyramid into winning positions. So if you can sit through some volatility, the price gets knocked down, you're at a half position size, you haven't been knocked out yet, it goes back up, you could put on another 50 share position, 500 share position, doesn't really matter what it is, and then tighten your stop. So you still have a good percentage, so you're not going to get knocked out of volatility, but you're adding capital to winning trades. And we talk about this mostly in our FX division, but if you're trading stocks themselves, this is something that you can do. The other thing you might want to do is switch to trading options. Spread trades are particularly good, especially for people who are learning how to do this, because you can sit through volatility. A spread trade is where you go long one option and then you go short another option. So let's say that I'm a trader who's looking to buy that XYZ stock again. What I might do is I might buy the $40 call, and I might if I'm expecting that it's going to go up to 45 in this next leg up, I might sell the 45 call against it. And I could probably buy the 40 call for about $3. It's about 5 weeks after expiration. I could probably sell the 45 call for $1, so my net debit would be $2. Actually, my net debit would be $200. But this means I've defined the risk on opening the position. My risk can never go beyond the $200 I put in on the spread. What this is going to allow me to do is sit through volatility. If I have an execution trader, an institutional execution trader, come in and attempt to spike the price down because they need to get in a lower VWAP, I can sit through it. My risk is already defined, and then when they begin to add to their position and drive the price up, I can then begin to take advantage of that as well. There are a lot more things to trading options than this. This is something that you really want to, if you decide that you want to look at this so you don't have to worry about the volatility of being stopped out, I'd recommend doing some serious investigation on it and see if this is something you really want to get into. Because done well, options are a great way to leverage your portfolio and manage your risk. If you don't know what you're doing, they are an excellent way to blow up your portfolio. So just bear that in mind. So in conclusion, there is no conspiracy among institutional actors to get your shares personally. They're just out to get shares. Don't care who it is at the lowest price possible. They're acting in their own best interests, as are you. You just have to respect that. Sometimes getting knocked out is a gift. Sometimes an institutional trader may spike the price lower to get all those stops taken out, and they might continue to spike it, and it might be the beginning of actual selling. So this is that's a calculated risk that the execution trader is taking, but that was probably going to happen anyway at some point in time. So maybe getting knocked out early is actually a gift to you. You always have to take that into account as well. There are ways to mitigate these effects. You need to know what they are, how to do them. One of the things you need to do is stick with very liquid issues. The two examples I gave you had very low volume. It is easier to do this in something that has low volume. If you tried to do something like this in the spiders, your order size would be millions of dollars. This is something that you could get into for $400,000. They could look to do this. So you want to have something that's very, very liquid. Not something that what people refer to as trades by appointment. And the last thing you do, consider trading options if this is really beginning to get you, because you can sit through volatility. A little plug about Maverick Trading. We're a proprietary trading firm. We've been in business over 20 years. We have two divisions. First is our stock options division. You can find that at www.maverickTrading.com. And the second is our Forex division, Maverick FX. That's at maverickfx.com. The three things that you need to be able to trade professionally: you need training, support, and capital. And we provide all of those to our traders because we have a vested interest in their success. If our traders are profitable, the firm is successful. If they're not, it's not good for anyone. So we make sure that we provide that training, the support, and capital to each of our traders. If you want to learn more about proprietary trading and see if Maverick Trading or Maverick FX are the places you want to be, go to one of these websites above, click Apply Now to learn more. Now, we do have a very in-depth application process, but that prepares our traders to understand what's expected of them as traders, what kind of training they're going to get, what kind of support they're going to get. We talk about the capital we provide as well. We just want to make sure that this is the best fit possible for the traders that do come with us. So thank you very much for your time. Best of luck in your trading. Cheers.